Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Tariff reprieve for Trump. Stocks slide as a federal appeals court sides with the US president on an earlier ruling blocking his tariff plans. In person with Powell, the White House says Donald Trump pushed Fed Chair Jerome Powell to cut interest rates in their first face-to-face meeting since the inauguration. Plus, Bailey on Brexit. The Bank of England governor urges the UK to strike a deeper trade deal with the European Union, warning that Brexit has weighed on the economy. A very good morning, everybody. Happy Friday. Welcome to nearly the weekend. And we've got futures pointing lower on both sides of the Atlantic because, strap in, my friends, the tariff uncertainty, the whiplash is back. It looks like, for now, Trump's got his way on tariffs. But for now, futures not liking what they see. You've got a bit of upside for FTSE 100 futures, but flip the board and perhaps you can see why. Because the dollar has been recovering somewhat and therefore cable is weaker at $1.34 at the moment. Meanwhile, we're looking at Brent trading at $63 a barrel, so shy of the 64 level as we head towards that OPEC meeting over the weekend. But gold down as well, down 0.7%. Interesting, and we'll come to it in just a moment, but we also had that raft of weaker than expected US eco data yesterday, weighing on Treasury yields as traders ramped up their Fed cut bets, and now you're looking at that 10-year yield at 4.42%. Flip the board because I want to look at what's happening in Asian markets as well. We had that upside surprise when it came to Tokyo CPI. But as I say, traders looking for some of the haven assets. And you've got the yen here at a 143 handle at the moment. The Nikkei taking a beating. Japanese stocks not happy this morning. But that's the case across Asia. So the MSCI Asia Pacific Index down 0.5%. And stocks in China not happy either because we've had the US Treasury Secretary Scott Bessent saying that trade talks between the US and China have been stalling. But I want to stay on that theme of trade in this risk-off environment, and let's get the details on the latest on tariffs. A federal appeals court has temporarily blocked a ruling that threatened to throw out the bulk of President Trump's tariff agenda. And despite the reprieve, the possibility remains that the appeals court could ultimately back the original decision and block Trump's tariff policy. It's all up in the air at the moment. Let's get more with Bloomberg's senior editor, Bill Ferries. Bill, relief for Trump for now, but what's his plan B if his appeal fails?
Yeah, so it is the White House was celebrating that decision by the appeals court to temporarily halt that decision that was basically wiping out a huge number of the Trump tariffs. But ultimately, they don't know how that appeals court will rule once it has more time to look over the case. That case could still go to the Supreme Court, and no one knows where that will wind up. So the Trump administration is making clear that they do believe they have other measures, other aspects of the legal code that can allow them to still pursue their tariff agenda. The challenge is the reason President Trump used this national declaration of an emergency to go forward with his agenda is because that was the fastest, easiest way to put tariffs in place and to put different tariffs for different countries. All of the other tools at his disposal will take more time. Some of them have time restrictions, and they're just a little bit more complicated. So while the administration doesn't want to go in that direction, depending on how this court case eventually winds up, they may have to do so.
And so how does all this legal back and forth affect the trade talks with other countries? As I mentioned, you've got the Treasury Secretary saying that trade talks with China are a bit stalled. But if I'm a negotiator, say, in the EU, I'd have my head in my hands.
Yeah, you may have your head in your hands, but it's not the EU, of course. It's India, it's Japan, it's a lot of big countries. For some of them, we know that they're considering maybe taking a little bit of a harder line position in these talks, knowing that at least a little bit of the leverage that Trump started off with maybe a few weeks ago or after that April 2nd Liberation Day it's starting to weaken a little bit. But it does add to the uncertainty. I think President Trump has made clear he's a big fan of tariffs. He's going to try to find a way to impose them. So there's probably no reason to walk away from talks. But you may want to calibrate your position a little bit if you think that the White House position has gotten weaker.
Yeah, I think he likes tariffs, Bill. I think we've got a taste of that so far. And maybe Keir Starmer regretting jumping into that UK-US trade pact so early. But let's also talk about the fiscal position, because investors have had time to comb through Trump's big, beautiful bill. And it turns out they found a worrying revenge measure, Section 899. What could it mean for markets?
Well, it's an interesting measure. It's getting a lot of people are talking about the Section 899. If this bill passes both houses of Congress and gets signed by the president, it would give the U.S. government authority to tax foreign individuals, foreign companies at a higher rate if the U.S. believes the countries that they're from have a discriminatory tax regime. So this is things like countries that have a digital services tax that the U.S. is trying to get rid of or oppose. And the real worry, of course, is this could affect sovereign wealth funds, companies, lots of foreign investors who hold U.S. treasuries, for instance. And the risk is that you drive more foreign investors away from things like treasuries, weakening the dollar, potentially raising interest rates and things like that. So it's generating a lot of alarm on Wall Street. It still has quite a ways to go to get to the president's desk. We know the Senate is going to change that House bill. But there are Republicans who say this is something that a broad number of people in President Trump's party support, so it may have a good chance of getting to his desk.
OK, Bloomberg's Bill Ferries, we thank you for that update. And I want to stay on the markets because it's been quite the roller coaster ride for them, given the back and forth on tariffs. Let's speak to Bloomberg MLive strategist Ven Ram now. Ven, good morning to you. Just talk us through the market reaction to the tariff whiplash, because it looks like that relief didn't last long.
Morning, Lizzie. And it's not going to last long either from going forward because, we've, as Bill was mentioning, I mean, this back and forth on tariffs is not going to sap sentiment. And what matters for the markets in the long term, regardless of what the geopolitical noises and all the tariff talk that we get, is what happens to aggregate earnings on the S&P. And if you look at the aggregate earnings estimates for 2025, they have been revised down. So in the face of aggregate earnings going down, it would be an uphill struggle for the S&P to keep rising. And therefore, I think that even a modest 5% decline in aggregate earnings would send the S&P well below 5,000. And we are not. If you look at the markets, obviously they are not even taking cognizance of the revisions down in earnings. So I think that the markets will come to terms with it. They will have to come to terms with it eventually when the economy shows that it's going down the hill. I don't think we are going to see that this month or next month, but as the second quarter numbers and the third quarter numbers start trickling in later in the year, I think that's when the markets will kind of get the message. For now, the penny hasn't dropped, but they can't wish away a bear market so soon.
OK, a reckoning coming for stocks, according to Bloomberg MLive strategist Ven Ram. Not for now, though. Looks like stocks hanging on to every little bit of relief they can find. Ven, we thank you for your analysis. Now, as I say, we've had Donald Trump and the Fed Chair Jerome Powell having their first ever face-to-face talks at the White House since Trump's inauguration. The White House saying that Trump pushed Powell to lower interest rates.
We saw, the president and I both saw the statement that the Fed put out after the meeting. That statement is correct. However, the president did say that he believes the Fed chair is making a mistake by not lowering interest rates, which is putting us at an economic disadvantage to China and other countries.
Well, let's get analysis now with Bloomberg's Kriti Gupta, our opening trade anchor, of course. And Kriti, we know that Trump wants Powell to cut rates. That's not new. What was the point of this meeting? Does it actually move the dial for the rate path?
It's unclear what the point of the meeting was, but we should mention this hasn't happened since November of 2019. So this is a really monumentous occasion between two people who, one, haven't spoken in quite some time. We know Jay Powell had conversations with Joe Biden as well in that term, but also at a point when we know Donald Trump, to your point, has been after Jay Powell to not only cut rates, but potentially not even be in the job. Now, he's always come back around and said, look, we're going to let Jay Powell finish his term into 2026, so that's not an immediate concern. But we do know he has been testing the waters from a legal perspective when it comes to other agency picks and whether or not he can actually remove them. And at the end of the day, Jay Powell is an agency pick from the Federal Reserve, nominated by none other than Donald Trump himself. But the history here in terms of the rate path is fascinating, because the last time Donald Trump kind of kicked off the trade war with China in his first administration, Jay Powell was famous for an insurance rate cut. The idea of we don't know what the economic outlook looks like, and therefore preliminarily we're going to cut rates even though we don't have it hit the hard data just yet. He's taking a very different approach this time because he's dealing with inflationary pressures that did not exist in that first term.
OK, so Trump would like his cut again now. Bloomberg's Kriti Gupta, who'll be back on the opening trade in just under an hour's time. We thank you. Now, to the geopolitics. Defence ministers and senior military figures are in Singapore for the annual Shangri-La dialogue. Our chief international correspondent for Southeast Asia, Haslinda Amin, joins us live. Lovely to see you, Has. What can we expect from this meeting?
Well, the focus at this meeting, really, Lizzie, is the messaging from the U.S. What role does it want to play in the Indo-Pacific, a region that's relied on U.S. engagement for a very long time to ensure stability, to ensure that Chinese influence is put at bay. But remember, this is not a U.S. that we know. There's been a lot of speculation of whether or not the U.S. remains a reliable partner. It's talked about wanting to take over the Panama Canal. Greenland is talked about perhaps Canada being the 51st state of the U.S. So lots of questions of whether or not the U.S. remains committed, the U.S. is reliable. And to that end, there have been countries, powers, that say that there can be an alternative. Talk about Macron. He is about to deliver that keynote address later today. And he comes to this part of the world saying, you know what? Europe, France would be a more reliable, a more respectful partner to the Indo-Pacific. And remember, you may not know this, but French frigates have been deployed in this part of the world. But is that enough? That isn't, because when it comes to relationships between the two sides, between Europe and the Asia-Pacific, the Indo-Pacific, we do not have that shared history. And therein lies the question. Who will play that role? Perhaps Japan, perhaps China. And we've seen the likes of Malaysia, for instance, leaning a bit more towards China. In fact, when it comes to the prime minister of the country, he's paid China a visit 3 times in the last 2 years. So it is a reassessment of alliances right now.
OK, so the geopolitical alliance is reforming as we speak. And you've already spoken to the New Zealand Defence Minister, Haslinda. New Zealand, of course, part of the Five Eyes intelligence sharing network alongside the UK and the US. Was she confident in Trump as an ally?
Well, that is the big question. She did say about how the policies being adopted by the U.S. and by the Trump administration is pretty much forcing countries to look at themselves, to rely on themselves, to think about strategic independence. We're already seeing this in Europe, where Europe itself is now looking at spending more on defense. So it's not surprising that countries like New Zealand, a pretty small country which has been relying on the U.S., is now looking inwards, looking at spending double the amount of its GDP on defense. What she was really cognizant about was the absence of the defense minister of China. This is the first time since 2019 that China has not sent its defense minister, and that possibly takes away the opportunity to have a high-level conversation between the U.S. and China at such a critical time, at a time when relationships are so fragile. But perhaps they say that, the uncertainty in trade negotiations has meant that China sees no relevance, perhaps, or little relevance in that conversation right now.
All right. Bloomberg's chief international correspondent for Southeast Asia, Haslinda Amin. Great to see you in Singapore on the ground for us at that Shangri-La dialogue. Lots happening in geopolitics, but also lots to come in terms of the economic agenda today. Let's take you through it. At 9 a.m. London time, we get the German states inflation data. So we'll look at this ahead of the national headline inflation print that comes at 1 p.m. Economists expecting that to have dropped to 2% in May. Then also at 9 a.m. we get the euro area money supply numbers. At 1:30 p.m. London time out of the US, we get the core PCE index. So more important, perhaps, in light of that revision lower on the first quarter personal consumption. And then we also get the University of Michigan Consumer Sentiment Index. So this is the final reading for May. It's expected to have improved given the de-escalation in the trade war with China. So definitely one to watch closely. It's all in the Daybreak newsletter, which I very much recommend if you are setting yourself up for your day. Just go to DAYB Go on your terminal. But right here on Daybreak, coming up, we're going to check in on how oil is heading for its second weekly loss ahead of tomorrow's key OPEC Plus meeting. Plus, later on, we're going to hear exclusively from the Bank of England Governor Andrew Bailey on the global impact of President Trump's tariff war and get the BOE chief's take on the UK relationship with the EU after Brexit. So stay with us for all of that. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:17 a.m. here in London. And I want to talk about commodities now, because oil is on course for its second weekly loss ahead of tomorrow's OPEC meeting, when the group's expected to decide on how much to raise oil output in July. And we can get a preview now with Bloomberg's Stephen Stapczynski, who, of course, leads our energy coverage over in Asia. Stephen, good to see you. We've got this meeting tomorrow, but it comes against the backdrop of all of the tariff whiplash. How much further do analysts expect the oil price to drop if there are more supply hikes? $64 a barrel, in fact below that this morning on Brent.
I think it really gets into how much is the market pricing this in, right? I think the market is expecting that there could be a larger than normal increase from OPEC Plus. That's something that Bloomberg has reported previously. It's something that analysts have called for. So it's really depending on the size of this cut. If they do decide to go with a kind of a triple, another 400,000 barrel a day increase, then that, I think, to a degree, is priced into the market. So while there is some downside, as the analysts are saying, it isn't a huge surprise. Now, of course, let's see what they do beyond that. Will they do a larger cut? Can they do a larger increase? Could they do something that's smaller? I think that's the specifics, as well as any more comments regarding where they will go from here, could potentially see prices shift higher or lower. But I don't think we're going to be seeing a huge decrease if at the meeting tomorrow they agree to just the 410,000 barrel a day increase.
OK, well, it has surprised us before, not so long ago, with tariffs again, the backdrop. But, of course, as well, gold has been on a roller coaster with all the tariff news and the US eco data yesterday. More to come today. What does it all say about the haven appeal of gold when you've got uncertainty back on the rise?
Yeah, I mean, I think, Goldman Sachs had a note out the other day saying that gold, and to a lesser extent oil, are the hedges for inflation, are the hedges for the trade war. I think one thing that has proven quite strongly over the last few months is that gold has been the bet that everyone has been calling for. When there's issues with the U.S. dollar potentially weakening, you go into gold. If there's uncertainty about global economic health, you go into gold. If there are issues with the U.S.-China trade situation and potentially a larger geopolitical disagreement there, you also go into gold. So that's been one bet that the market has consistently called. I think what's kind of interesting over this last week, though, is that gold hasn't really shown up, right? Prices gold futures fell because you saw a few things. You saw the Trump pushing back the Europe tariffs, as well as you saw the courts kind of potentially delaying or getting rid of, at least temporarily, the tariffs that Trump has has pushed forward. That kind of took some of the wind out of the sail for gold. We still are near record levels. We're down a little bit today after a slight rise yesterday. So you're not seeing the piling in this week that you've seen previously. But I think in the long term, when you talk to the analysts, when you look at what people are saying, gold is that hedge. And it is something that it seems that a lot of portfolio managers are including in their system, in how they look at the market going forward.
Okay, Bloomberg Stephen Stapczynski in Singapore, we thank you. As we think about gold's safe haven status heading into the weekend. Coming up, we're going to turn to the politics in Europe. We're going to head to Warsaw to look at the key issues driving voters in the Polish presidential elections. So that's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, voting takes place on Sunday in the second round runoff of Poland's presidential election. The Liberal mayor of Warsaw is up against a historian backed by the opposition nationalists, with polls putting them neck and neck. It's a nail-biter. Let's get more with Piotr Skolimowski, who is in Warsaw and leads, of course, Bloomberg's coverage of Central and Eastern Europe. Really good to see you, Piotr. I mean, for anyone who's not been watching this vote as closely as you, just take us through who the candidates are and what exactly they're campaigning on.
Hi, Lizzie. Indeed, it's a bit of a nail biter and coin toss, or whatever metaphor you want to use, but it's definitely a very tight race. So we have two candidates essentially in this runoff. As we mentioned, Warsaw mayor, who is a polyglot, son of a prominent jazz musician, Rafał Trzaskowski, and he's coming up against fairly new face on the political scene, Karol Nawrocki. He's a former boxer as well, and he has a bit of a checkered past that's been coming up to light and sort of keeping everyone excited about this race coming into Sunday. It's if you look at those two characters, they basically show you how divided the country is. Two different versions of Poland. One with Trzaskowski, who's very much pro-European. He's very friendly with the government, and actually he's a candidate of the government. So government is hoping that by having him as a president, it will be easier for them to push forward with a pro-EU agenda. On the other hand, Nawrocki is very conservative. He's the representative of the opposition, and he also got MAGA endorsement just this week. Homeland Security Secretary Kristi Noem was in Poland at CPAC conference, and she said, "I'm here on behalf of President Trump, and Karol Nawrocki should be your president." So he's coming as this candidate who's railing against migration. He's very much skeptical of climate change, and he's standing for traditional values, as he puts them. So you basically have two visions of Poland on the ballot this Sunday.
OK, so hugely consequential for Europe, maybe another test of Trump's influence in Europe. But let's also just think about the market reaction, because so far Poland's had this world-beating rally this year. How much is this vote going to put that to the test?
Indeed, the Polish assets, both stocks and bonds, but also the currency, has been on a tear, and this was basically a result of the fact that when the current government came to power in 2023, the expectations were they were reversed. Those times of populist government that were Poland had for the past 8 years, and they will introduce reforms. They will get Poland closer to the EU mainstream. Also, Poland has really envious metrics when it comes to economy. It's one of the fastest growing in the EU. So there were expectations that things will only get better for the Polish economy for where it's going next, and that's where we saw the markets reacting accordingly. Now, the big question now is Poland also has huge deficit, which it also has a lot to spend on defense. So the question is, if the government doesn't get the president that they want, that will be working with them, it may put all these plans for reforms to test and put in question.
OK, Bloomberg's Piotr Skolimowski in Warsaw, who's going to have a busy weekend. We wish you luck covering those Polish elections. Thank you, Piotr. Next up, Hetal Mehta. We'll talk more on the markets. Stay with us. This is Bloomberg. A very good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Tariff reprieve for Trump. Stocks slide as a federal appeals court sides with the US president on an earlier ruling blocking his tariff plans. In person with Powell. The White House says Donald Trump pushed Fed Chair Jerome Powell to cut interest rates in their first face-to-face meeting since the inauguration. Plus, Bailey on Brexit. The Bank of England governor urges the UK to strike a deeper trade deal with the European Union, warning that Brexit has weighed on the economy. Those are your headlines this morning. Welcome to Friday's show, everybody. And it looks like that trade uncertainty is hanging over these markets yet again. For now, it looks like Trump's tariffs are here to stay. So we've got futures down stateside, pretty flat here in Europe, flat to the downside, but optimism here in London. And flip to the cross-asset picture. You can see euro-dollar is actually down as the greenback recovers today. We've got oil there just below $64 a barrel, on track for a second weekly decline as we head towards that OPEC Plus meeting over the weekend. Gold down as well, interestingly, as a safe haven. But we also have had treasuries higher as we had traders cranking up bets on Fed cuts after the weak US eco data yesterday. And you're looking at the 10-year treasury yield now steady at 4.42%. But plenty more US eco data to come later through the day. Let's talk about it all now. We've got Ben Ram, our Markets Live cross-asset strategist, with us again. Good to see you again, Ben. Let's just look at what the Fed's been saying, because the Fed has been waiting for clarity. Tariff uncertainty is here, though, and therefore you've got fiscal uncertainty as well. That's only mounting. So what's the bigger headache for the market? Trade or fiscal?
I think it's a combination of both, Lizzie. I mean, the market's gone gloss over either. And then there is the third component that we talked about. The most important component is how does a tariff and how do those fiscal deficit concern trickle down to the aggregate economic earnings, which is a big thing. The markets are thinking that, look, I mean, this has been a short bear market. If you think about it, we made the lows in the first week of April, and then we have had such a strong rebound that people are kind of questioning themselves whether it was wise to have sat out the rally, the rebound. But if you past history, what it shows, Lizzie, is that an average bear market lasts about 14 months, and the median decline in a bear market is about 34%. Now, what we have seen so far is nothing on that scale, either in terms of time. Obviously, we've bounced back in a month. And then in terms of the decline, we've done about 21%. Of course, I mean, a lot depends on how the economy is going to evolve. But with this tariff uncertainty, you've got the prospect of empty shelves and higher inflation. So that is going to cramp the Fed in terms of the room that they have to cut. And also the deficit concerns are not going to go away. I mean, we have seen a slight leg higher in treasuries, long-dated treasuries. But if you look at it, if you pass the 10-year yield, Lizzie, what do you get? I mean, you've got core PCE that's coming today that's expected to be 2.5%. And of course, that's a kind of a true representation of what we have been seeing over the past 1 year. 2.5, 260, 270 is what we have been seeing. And if you take economic growth of 2%, the Fed thinks it's going to be 2.1%, incidentally, this year. So if you assume 2% growth and 2.5% inflation, you get a 10-year yield of 4.5%, which is what we've been seeing in the markets. So in a world of 4.5% 10-year inflation, is a 30-year yield at 5% too bad? It's not looking too shabby at all. And you've got to have a risk premium on the 30-year. If you're going to assume that if this tariff uncertainty is going to stay and stoke inflation, and also the risk premium for deficits. I mean, if the tax bill clears the Senate and you've got, the deficit spiraling out of control, that's a very big question mark for the markets, and treasury yields will push higher. And if Treasury 30-year yields go to 530 or anything of the sort, the stock market will start shivering. Make no mistake about it.
OK, Ven Ram, we thank you, our Markets Live cross-asset strategist, and you can get Ven's thoughts on the MLive blog. Just go to MLIV Go. Now, joining us for more on the markets is Hetal Mehta, Head of Economic Research over at St James's Place. Really good to see you, Hetal. Good morning to you. Happy Friday. I hate to say it, but the trade uncertainty is ramping up again. Trump's got this reprieve on the tariff ruling for now. He's looking, though, for other options. I just wonder how damaging you think all of this is going to be for the US economy. How has it changed your outlook on the prospects of a potential US recession?
So overall, we haven't actually changed our recession probability for. It's actually been 2 months. We moved up to about 35% ahead of Liberation Day. I'm not going to take too much credit for not chasing up the recession probability immediately after Liberation Day. Economists can understand why if those were going to stick, they were going to really tip the US into recession. But from our perspective, it was a case of wait and see. Does the market provide some sort of disciplining factor to the government? And in some ways, that's what we saw. With the latest news, the tariffs obviously are still in place until the appeals process is completed. And we do think that we will start seeing that impact of inflation coming through. But there are reasons to think that the US isn't imminently going into recession. We've got a strong starting point. The fiscal situation is actually still quite loose. And so, the Fed also does have space to cut rates if we start seeing those cracks in the labour market. So it's finely balanced, and I can't say we have very high conviction. I'd be surprised if many people say they have high conviction, but we think that the US is likely to avoid recession this year.
Well, yeah, I'd love to get your take on what Ben was just saying there, because, of course, Trump needs the tariff revenue to fund his tax cuts. So the two stories of tariffs and fiscal are interlinked completely. Is actually fiscal the bigger headache for the market?
I think on whether the government can really reliably expect tariff revenues to fund tax cuts, I think there's always a question mark in our eyes, because once tariffs increase, there is almost a kind of diminishing return. You don't quite get as much tariff revenue. You do get substitution. You do get supply chains rerouting. So there was, I would say that we were somewhat skeptical that all of the tax cuts could be funded from tariffs, and then that does mean where does the money come from for all of the tax cuts? So I do think the fiscal situation in the long term is probably the one that's more worrying, and inflation being a concern. That's why we're seeing things, we've seen the bond market sell off because those inflation concerns are still quite prominent.
Well, yeah, so looking at the bond market, you had Treasuries gaining yesterday on these bets that the Fed is going to cut rates this year, ramping up those bets. How many cuts are you looking at, and when are they coming this year?
So, I mean, we don't make explicit forecasts on rates, but I do think that for the Fed to exert its independence, there's actually a reason to think that until they've got that real strong evidence that the labour market is weakening, that the economy is heading towards recession, that they might end up waiting longer to cut and to exert their independence. And then when they do cut, they could cut more aggressively. I would say maybe 2 cuts this year wouldn't be unreasonable. I think, we think overall that, rates market looks, the valuations aren't at extremes, really.
OK, that's interesting. But in this environment of higher bond yields, do equities look much less attractive?
So for US equities, I mean, the valuations have been stretched for a very long time. We think that much better returns to be had in other regions. So we think European equities, Japanese equities, UK, even emerging markets, we think that we balance a kind of slightly less favourable view of US equities in other regions.
I just want to turn to the UK's fiscal situation, Hetal, as well, because there's this interesting commentary from the IMF on what the Chancellor Rachel Reeves has been doing, you know, warning that she needs to stick to her fiscal rules if she wants to avoid further market volatility, and making this suggestion that they should only have the Office for Budget Responsibility commenting on headroom once a year. Of course, that's what Reeves wanted, but isn't that surely less transparent? Would that actually curb the market volatility here in the UK?
I'm not convinced it would. People and economists are always reading between the lines every data point, especially when the margin for error seems so slim. So having the OBR opine formally only once, I don't think would be a material difference. There's obviously political pressure that comes with every announcement, where there's the need to make sure that the fiscal rules are being met, but that I think is that's still likely to be there, unfortunately.
OK. Hetal Mehta, Head of Economic Research over at St James's Place. Lovely to see you. We thank you for all your analysis this morning. Now, I want to stay with the UK because a gauge of UK business confidence has risen to a 9-month high as markets rebounded and trade tensions eased with the US. The Lloyd's Business Barometer sentiment gauge rose to 50 in May, the highest since August, just after the Labour Party's election win. The 11-point jump erased the drop seen in April when President Trump's tariff hikes sowed turmoil in international financial markets. Now, meanwhile, Bank of England Governor Andrew Bailey has urged the UK to strike a deeper trade deal with the European Union to not only improve growth but minimise the negative effects, as he puts it, of Brexit. Let's hear what else he had to say when he was speaking exclusively to Bloomberg's Francine Lacroix.
Look, I start from, as I said in the remarks I made, I start from the point that trade is, an important underpinning for growth. It's an important underpinning for activity in the economy. There are lessons to learn from recent years, which we can put into effect. But there's no question that open economies are important. And let me put this into important perspective. And this is the story on growth. I mean, the UK is not alone in this respect by any means. So this is it's a UK story, but it's not a uniquely UK story. We have had a lower potential growth rate in the UK for the really since the financial crisis. By the way, I'm not sure that's causal, by the way, but it happens to coincide. So, the point I was making is that if you go back before the financial crisis, the potential growth rate in the UK was probably around 2.5% a year. Since then, it's been 1 to 1.5%. And most of the difference is to do with productivity and to do with investment. And, you look at the job we have with monetary policy, which is balancing supply and demand. You look at, obviously, the job that, fiscal policy has. It is harder to run macroeconomic policy when you've got a lower growth rate. I mean, history tells us this. So raising the potential growth rate is critical. And I say the UK is not alone in this respect.
How much more necessary is it because of the trade war also that we're seeing? I
think it underlines the importance of it because the trade situation will, if the world economy fragments, that will also have an impact on growth. The point I made, it impacts on things like knowledge transfer, it impacts on supply chains. So it will have an effect, yes.
Is the world fragmenting for real, or are these just jitters that then will settle?
Well, I hope we can get past the sort of disruption we're going through. And it's why, as I said in my remarks, I do think it's critically important that that we focus on ensuring that what I call the multilateral system is rebuilt and is robust. And I include the World Trade Organization, I include the IMF. Because they are absolutely important, fundamental sort of parts of the system.
Yeah. But does the current, trade turmoil make it more necessary for the UK and EU to get together? 100%.
Well, I think it does emphasise the need to do it. Yeah, because it puts all of us in a situation where we've got another risk to activity in the economy. So I think doing everything we can to rebuild that relationship in this situation. But of course, we also don't, by the way, we don't want to lose the relationship with the US. We really want to get to the issues that are underlying this and help to solve them. It's not something we want to sort of wish away.
The Bank of England Governor Andrew Bailey there, speaking in Dublin exclusively to Bloomberg's Francine Lacroix. Now, to some other stories making news this morning. European Central Bank Governing Council member Peter Kazmir has been convicted of bribery and fined €200,000. In a ruling that will cause embarrassment, no doubt, to the ECB, a court near Bratislava said that if he fails to pay the fine, he'll need to serve 1 year in prison. Kazmir says that he will appeal and doesn't intend to resign from his post heading Slovakia's central bank. Elsewhere, President Trump will hold a news conference at the White House alongside Elon Musk today to mark the Tesla CEO's departure from his US government role. The world's richest man is officially leaving his position, leading an effort to slash the size and scope of the federal government. Musk has recently criticised Trump's signature tax and spending cut proposal. And Harvard University has won a longer-term reprieve from a Trump administration ban on enrolling international students. Harvard sued the administration last week, claiming that the ban was illegal. Washington maintains the Ivy League school failed to comply with the terms of its certification for enrolling foreign students. On Thursday, the US moved to start revoking visas for Chinese students with connections to the Chinese Communist Party or who are studying in critical fields. And Israel has accepted a US ceasefire proposal for Gaza that Bloomberg understands involves a 60-day pause in the fighting and the restoration of UN-led aid distribution. The White House press secretary says that Israel signed off on the proposal before it was submitted to Hamas. The militant group has criticised the proposal but hasn't officially responded to that latest offer. Those are some of your top stories this morning. Coming up right here on Bloomberg Daybreak Europe, the case against Google's search dominance is heading into its final arguments. We're going to look at the case and how it's already changing the online search market. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:48 here in London, and I want to talk tech now. Google and the US Department of Justice are slated to offer their closing arguments today in an antitrust case that caps a busy spring of litigation over the size of big tech. And Charlie Wells has been all across the details, so we can speak to him now. Charlie, just take us up to speed on Google's antitrust issues. What's going on here?
Yeah, so they've certainly been accelerating this spring, and basically we are now at a point where in less than a year, Google has been found to be a monopolist in two key issues in the internet by two different federal U.S. judges. So this is a significant development. And basically today we're going to be hearing these closing arguments in a search monopoly case. So one of the areas where it was found to be a monopolist was in search. The other was in advertising. So we're going to be hearing these arguments today. Those are scheduled in just a few hours in a federal court. And the Department of Justice sued Google and has been pushing for Google to have to spin off that Chrome web browser. So this is the remedy phase where the judge is trying to figure out what to do to correct for this monopoly. Now, Google has ardently defended against this sort of remedy. Sundar Pichai, the CEO of Alphabet, was even testifying, talking about how there could be unintended consequences to moves like this. So Google wants less, quote unquote, extreme remedies. But what's been really interesting about these hearings has been this issue of AI that's been coming up in the background. The judge has been asking about it, and that's what makes this such a salient case today.
Yeah, so what's the likely outcome then? Are you going to see Google split up?
So if you look to history, I think you don't get a very good sense of a split potentially happening because the U.S. government has not successfully split up a company since 1982 when they split AT&T. Now, a lot of us will remember that 1998 trial with Microsoft regarding monopolies, but they were ultimately unsuccessful there. So, I think that's one of the issues. But we have seen this spring just the volume of cases regarding antitrust pick up. So it's not just been Google. We also have the FTC case against Meta. We have the Department of Justice suing Apple. So there is this sense of momentum here, and also this issue that judges do not operate in a jurisdictional vacuum. So there is this sense that, with these cases, they could feel emboldened, and we're not just seeing this sort of issue in the U.S., we're also seeing it in Europe.
Well, yeah, so you've got all of that momentum. Are we actually seeing a broader shift when it comes to antitrust and big tech?
Well, striking here has been this kind of through line we've seen from the first Trump administration taking on big tech from an antitrust perspective through the Biden administration, which seems quite striking, and then continuing into Trump 2.0. So that is one thing that has surprised a number of people. But also on this side of the Atlantic, you've got a new competition czar here in Europe. Under her tenure, there have already been fines against a number of these big tech companies. And so it's feeling like we're at something of a pivot point, all, as I mentioned before, with AI in the backdrop, because I think that is what is animating a lot of this sense that these large companies could continue their dominance as this new technology starts to emerge and take hold.
OK, fantastic reporting. Our very own Charlie Wells, we thank you for that update. Now, staying with tech, Dell has given a profit outlook for the year that topped estimates. The company says that AI server demand is unprecedented, with more than $12 billion in orders last quarter alone, which exceeded shipments for the entire prior fiscal year. Dell says that the AI market is exciting but also lumpy, with a highly complex supply chain. Well, that is some of our top tech news this morning. We've got plenty more coming up still on the programme, so do stay with us. This is Bloomberg.
I think we're towards a taco moment. And so I think the odds right now of a recession this year are way elevated from where they were on election or inauguration day, but are probably just below 50-50, given the inflation pressures that are coming from the tariffs. I think the Fed is not going to be in a position to move very rapidly.
Former US Treasury Secretary Larry Summers speaking there. He says that the odds of a US recession are elevated again, and the trade picture isn't helping. Take a look at this chart, and you can see that the uncertainty around trade is actually creeping up again. We may be past peak uncertainty, but maybe we're coming back to even more uncertainty now. Now, when you look at the reaction in the market to all of this, it's interesting. Flip the board, because there's a bit of a divergence. So here, with the circle, you've got so-called Liberation Day. Now, in the white line, you've got the dollar, which is still, of course, below this Liberation Day level. But then look at stocks creeping higher, more than creeping, actually, every single time they get a bit of relief. And so that divergence, somewhat puzzling, perhaps, given the real economy picture. Flip the board again, and you can see what's been happening in GDP. You can see the misery at the start of the year, struggling to get off its feet for GDP in the first quarter. They're just some of the terminal charts to set you up for your day. Just go to GTV Go on your Bloomberg terminal if you want to find them. But there's plenty more coming up right here on Bloomberg. Stay with us as Kriti Gupta and Guy Johnson take you all the way to the opening trade coming up next. This is Bloomberg.